Assalamualaikum warahmatullahi wabarakatuh to Miss Fauziah. My name is Muhammad Syarafuddin bin Noor, and today we are going to discuss about topic 5, currency option and future. Okay, now is the definition or introduction for currency of future and option. The first one is currency option is the right to buy or sell a foreign currency at a specific price by a specific date. And for the currency future is the right to buy or sell also by a future contract of a foreign currency at any time for a specific period. Okay, now we are going to define a derivative market. Derivative market is referred to a financial market such as future and option market based on value on underlying asset. The participant of derivative market is four participants: is hedgers, speculators, arbitrageurs, and margin traders. And the type of derivative market also has four contracts, which is option, future, forward, and swap. Okay, now we will discuss a little bit about participant in derivative market. The first one is hedger. Hedger, their job is to lessen the risk of the price volatility in the exchange market in the future. The second one is speculator. Speculator, their job is to buy any financial instrument and believe the investor that their price will increase in the future. The third one is arbitrager. Arbitrager is the typical profit making activity in the financial market. And the last one is margin trader. Their job is to cover the credit risk connected with the investment in the finance industry. For type in derivative market, there are four types: option, future, forward, and swap. For option and future, we had already discussed about it. Now we will talk about forward and swap. Forward is similar to future, but they are over the counter item. And swap is a financial derivative contract, which is two holder or contract parties exchange financial responsibilities. Okay, now we'll be discussing about the concept of currency future. This contract is a standardized contract that are trade on centralized market. And for the currency must be exchanged for the amount specific in the contract size. And the component, there are four components. The first one is underlying asset, expiration date, size, and marginal requirement. Now we will discuss a little bit more about the component in the currency future. The first one is an underlying asset, which is a specified currency exchange rate. The second one is expiration date, which is a final settlement or date which the currency or cash settle in the future. And the third one is the size. The size of the contract are same. For example, is standardized at 125,000 euros. And the last one, margin requirement. Margin requirement is a which is necessary to have a starting margin, but if it fall below the starting margin or margin maintenance margin, the investors must deposit a fund to raise back at initial margin. Now we will show you the example of currency future to make it more understandable. Suppose euro need to be converted into dollar in 3 months time. There are two ways. The first way is a contract currency of euros. They need to sell a euro and hedge by selling 3-month euro future. And the second one is contract currency of dollars. They need to buy a dollars and hedge by buying 3-month dollars future. Next, we move to another currency, which is the concept of currency option. Currency option has two options: call option and put option. For call option is the enable the buyer the right to buy, and for put option enable the buyer the right to sell. These are the difference between these two options. There are also an example for the currency option. There are example for buyer and seller. For the buyer, they must buy a 3-month dollars and call NNR to put option on 2 million. And the for seller sold a 3-month dollar and put INR on call option on 1 million. The currency option must to buy or sell currency pair at pre-specified price, also known as strike price. How currency option and future use hedging in the forex market. For option, they use hedging to protect them from foreign exchange rate, and for future, the importer or the foreign currency borrower hedge their risk by buying the USD INR future. And for speculating, for option, they use speculating where to make profit from the price volatility. And the future, by shifting the exchange rate, the trader expect a currency to approach against another, and they can buy a foreign future contract. Now we move to the difference between future and forward contract. In form of contract, future is standard contract and forward is a unique contract. And for settlement, it can settle at any time for the future. Other hand, for forward, is settled upon maturity. And for regulation, for future regulated by the stock exchange, and for forward is non-self-regulated. And lastly, for trading, future organized stock exchange platform, and forward is over-the-counter items. And difference between future and option contract, which is that for future both parties share the risk, and option is risk is borne by one party. For future is a poor trading tool, while option is a risk limiting tool. And the last one, amount of loss or profit in future depend on the price, while option amount of loss is restricted to the option premium paid. In conclusion, we can conclude that understanding the concept of future and option allow us to plan how we will build our position for greatest impact. Options are more diverse and sophisticated than futures. It is because allowing us to develop excellent option trading technique can take us to the advantage such as time decay and price volatility. That's all from me. Thank you for your time for listening my presentation.